As you've probably heard by now, there is an alarming possibility of a recession looming on the horizon, and it might just be more than speculation. Many people have speculated for some time now that we might be heading towards a recession this 2022. Some have denied these claims. However, as they believe that after the very brief yet devastating recession during the dawn of the COVID-19 pandemic 2 years ago, businesses are already recovering from losses and making improvements day by day. Despite that, there are still doubts among many people. With that in mind, it poses the question of how close are we really to having yet again another recession? And could we possibly be already in the start of one? Let's find out in today's video. Hey, welcome to Stock Market Mate. Today we'll talk about the warnings of a recession and what's in store for the stock market in 2022. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. The economy has been gaining a lot of concerns from the public lately due to the fear of having a recession in the upcoming months. Among them, it was reported that 6 out of 10 were increasingly worried that a major recession is just right around the corner. That is according to a survey by Allianz Life, a leading provider of annuities and life insurance. But why are they so afraid of a recession anyhow? What makes them so sure we were on the brink of one? Well, according to CBS News, there's been an evident decrease in economic activity in the first 3 months of 2022. Additionally, inflation is at a 40-year high with the stock market seemingly sinking. However, even with that evidence, some economists still claim they do not think there will be another recession this year. They say it's more likely to be hard landing in 2023 connected to the Fed's increasing interest rates. Hard landing, by the way, refers to an apparent economic downturn, which typically happens after a period of rapid growth. The Feds do this as a way to lessen inflation. However, it could go wrong in many ways if businesses hastily pull back. Despite economists denying that there could be a recession this year, consumers have been combating headwinds recently, which are undoubtedly impacting their wallets. In particular, although salaries are increasing, inflation is mercilessly consuming these gains, which means people are struggling financially. Knowing all of this, let's now take a closer look at what exactly causes a recession. Understanding a recession and how it is caused. Some sources explain that a recession is a consistent decline in GDP in the span of more than 2 months, particularly 2 consecutive quarters. And normally, that's usually what is considered to be a recession. However, during the COVID-19 outbreak in 2020, we experienced the shortest recession in history, with a duration of 2 months. The COVID-19-driven recession was considered a recession because it basically plunged the economy deep into an extreme decline. Although it was brief, its effects were drastic and devastating. This year, the US experienced a downturn in the first quarter, including an abrupt drop in exports, as well as a very slow restocking of goods in stores, not to mention the reduction in federal, state, and local government spending. During the same period, nonetheless, consumers and businesses spent heavily. Personal consumption expenditures, non-residential fixed investment, and residential fixed investment all increased. Furthermore, despite all that, economists are expecting an increase of 2.9% in GDP during the second quarter of 2022. According to the credit rating agency, all of the jobs lost during the COVID-19 pandemic will likely be recovered by the third quarter of 2022. Will there be a recession now? So with all these economists denying a possible occurrence of another recession this year, what are the odds of actually having one? Well, there is the proof of the current inflation. In fact, the CEO of Bank of America expressed, "Inflation shock worsening, rate shock is just beginning, recession shock coming." A new government report on consumer prices showed that it rose by 8.5% during March 2022, making it the fastest pace since 1981. In addition, prices spiked by a record amount on everything from new cars and men's apparel to baby food and salad dressing. They're basically warning us that inflation is out of control, which can only mean it's leading to something very bad, such as, yep, you guessed it, recessions. Although the Bank of America has not directly predicted the recession in the United States, they are pointing to signs of a slowdown and recession on Wall Street. Furthermore, it's been reported that financial markets have been very recessionary, as firms like home builders, semiconductor manufacturers, small caps, retail, and private equity are all showing steep declines. What's more is that the Bank of America surveyed the global growth expectations among investment fund managers and found that they have plummeted into an all-time low during April. The survey also revealed profit expectations among investors fell to their lowest level since March 2020. Just last month, Deutsche Bank became the first major financial institution to forecast a recession. According to the bank, the Fed is likely to trigger a mild recession in late 2023. Furthermore, Carl Icahn, an American financier and founder of Icahn Enterprises, expressed that a recession or even worse was coming. During a report published in March 2022, economists at the Dallas Fed warned that if Russian oil exports were cut off for much of this year, a global economic downturn is inevitable. On the other hand, stock traders appear more optimistic, with the S&P 500 rising in 5 of the past 6 trading sessions, regaining much of the ground lost since the peak reached in January. Bond market signals are more mixed. but some parts of the market also suggest traders do not expect a recession anytime soon. Anyhow, it's impossible to know if we're even experiencing a recession or not, and it'll be months by the time that you do, as most people can't tell if they're in a recession until it's too late. Possible recession indicators that you can consider. Although no one can exactly tell for sure if a recession has occurred, there are ways such as indicators that can help you sort of determine whether it is indeed a sign of a recession or not. After all, according to a CNBC article, it's not just bond and stock markets that can tell signs of an economic slump. There are several economic data liquidated that appear to be recession signals. This includes employment and consumer spending data. People monitoring the market have also turned to other ways to evaluate the economic health of the market. Such indicators include Skyscraper Index. In 1999, British economist Andrew Lawrence coined the idea of a skyscraper index, which connects construction of the world's tallest buildings with the beginning of economic distress. He further explained in an interview in 2012 that he looked over data as far back as the late 1800s and discovered that there are correlations between the economic crisis and the finalization of the construction of the tallest buildings in the world. Evidence of this is found in the completion of construction during the Great Depression of the Chrysler and Empire State Buildings in New York. Lawrence notes that the completion of these skyscrapers tend to bring an end to an era of large building booms. Men's Underwear Index. Back in 2008, during a global financial crisis, former Federal Reserve Chairman Alan Greenspan explained to NPR correspondent Robert Krulwich that because underpants tend to be one of the last pieces of clothing that men would purchase, it served as a great indicator of when times are not good and there's a financial struggle among people. Furthermore, he added that sales of men's underwear seems to be quite consistent, though declines in sales means that men's finances are so stretched that they refrain from purchasing replacements. Hemline Index. The idea of the hemline index rose on the back of a thesis by economist George Taylor during the 1920s. This theory suggests that apparently the length of skirts can tell if the market is in crisis. Shorter skirts meant the market was on the rise, while longer skirts meant that there was a downturn. Among the examples quoted in support of this theory are the economic exuberance of the 1920s, knee-length flapper skirts, and the emergence of the miniskirt during a period of stronger financial conditions in the 1960s, although many are actually still skeptical regarding the credibility of this idea. Lipstick Index. Last but not least, we have the Lipstick Index. The Lipstick Index was developed by Estee Lauder chairman Leonard Lauder. Lauder suggested that women are likely to spend more on small luxuries such as lipstick as coping mechanisms when times are hard. However, this theory was not proven to be accurate during the COVID-19 pandemic, as sales of cosmetics dipped instead, due to the consumers staying at home during lockdown because of restrictions. And that concludes our take on the possible recession happening this 2020. What do you think? Are we likely to be heading towards another recession this year, or perhaps we're already experiencing the beginning of one? Ultimately, it's hard to deny that there are a great deal of warning signs telling us that a recession is nigh. In the end, recessions, although can be devastating, usually end after 18 months, which means it won't last forever, and things will eventually recover one way or another. That's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!